Okay, welcome to the latest episode of the Quantcard MoneyWise podcast. I'm George, your host, and I'm thrilled to have Mikhail and Graham from Amati joining me today. We'll be delving into the strategy and discussing the roles of both active and passive investment approaches. I've had the pleasure of knowing Mikhail since his days at Aberdeen and Aviva, which gives us a unique opportunity to explore the contrast between large investment houses and specialist fund houses. I recently listened to their latest update and it sparked a few questions, which I hope to kind of pick up during this. Is there a risk of selling out too early? What does active management truly mean? And where does active management fit in today's market? So I want to kind of dive straight in, perhaps with a couple of easy questions for both of them. Is perhaps just giving us a brief overview of career to date and backgrounds.
Of course. Shall I ask? And actually, Graham and I share some similarities in our arc of professional career, both having worked in very large organizations and run large global equity franchises, and then arriving at a similar point in our career, wanting to do something a bit more focused, quite a lot more focused, and a lot more entrepreneurial. I started on the buy side in 2002, and for 5 years I worked with the founder of Amati, Paul Jordan, on the UK Smaller Companies Fund and Venture Capital Trust at what then was called First State Investments. And before that, I was in corporate finance. I was an investment banker doing M&A or raising money for technology companies in Eastern Europe. After First State, I went where I did UK small caps. I went into global equities at what then was called Standard Life Investments, and I still think about it this way, in 2007, and ran high conviction funds, eventually running for about 8 years a flagship global equity unconstrained fund, which George, you might remember from our prior conversations, running the global team there. I then did something similar at Aviva Investors for a few years and joined to launch the Global Innovation Fund here and joined Graham in that enterprise in early spring 2022. So we're about to turn 3 as a team.
Yeah, and as Mikhail says, we share a similar background in that I also started in smaller companies, originally with the UK and then European small cap at what was Foreign and Colonial and became F&C. And then I went on to run European and global funds at AIG Investments and latterly PineBridge, which span out of AIG. So, I kind of went from doing very small companies in one market to doing all companies, including very large companies across the global markets. And it's given me good perspective, and that's helpful when it comes to running a very concentrated fund like this that's very innovation focused.
I think both of us with our small cap origins also had this hard school of, small cap world, nothing's pre-digested for you. There is research coverage, but you don't get 20-page initiation notes and detailed models. You do a lot of digging yourself, and dare I say we enjoy doing that, and that primary research work is quite essential to the work we're doing today.
I'm working in big firms, so large investment houses, and then you come to Amati, which is kind of smaller specialist. Do you see differences between kind of that large and small? I guess it's in terms of investment decisions, day-to-day operations. How is the mix different?
Well, there's lots to say. I think between us, we'll cover a few things that spring to mind. First and foremost, you do exactly what you need to do. What happened to me, and I'm sure it happened to Graham in his career as well. You end up inheriting a legacy of what was being run there for a while. I remember running global equity strategies, which frankly had no future, but had some legacy clients, global equity ex Japan with a +1 performance target. We had to do it. It was, dare I say, distraction from the high conviction work we're doing elsewhere, but we had to do it because we had a big client, and that's what we've been hired to do. In small organization, especially when you launch a fund, you do everything as you think is right from the start. We often say, and we really mean it, that we launched this fund to run money the way we want our money to be run, and we seeded that fund with our money, so we definitely put money where our mouth is. But it's that complete focus on this is the important work I need to be doing to grow wealth of my clients, and I have virtually no distractions. That's a luxury that we didn't have in larger firms.
Yeah, exactly that point. And also, as Mikhail said, because we started this fund, we both brought to it a lot of experience of running concentrated portfolios in other places, often in places where you, to some extent, inherit the investment process or the investment style of the organization. And we both have our own very clear views about how money should be run for the long run. And because most of our money is in it, that's the way we think about it. We think about it as building capital over time in as low a risk but high growth way as we can. And so we've designed the process here to be very robust and rigorous, but only with that in mind. So there are no distractions, no other things we need to be doing. It's very focused, and it's really a clear manifestation of exactly the experience we bring to this product and the way we think about investing.
And the negatives, if you like, to be balanced, is you have more resources in large firms, and it was I wouldn't say it was a concern. It's something we've thought about very long and hard in saying, hey, we used to have the benefit of working with lots and lots of other investors, and that gave you a bigger coverage list and broader wall of information coming at you. Can we do this here as effectively? And I'm pleased to report that we can. That the benefit of focus outweighs a lower resource bandwidth, because we don't have to run a whole bunch of things we don't longer need to run. We don't need to look at things we no longer need to look at, be distracted by. And if you look at specific metrics, I mean, when I look at the number of companies we meet as investors compared to what we used to be able to do before, number of conversations with experts, number of trade shows we attend, the depth and quantity of investment work we do ourselves, in my humble opinion, quality is higher than it was when we had much bigger research budgets and lots of analysts to talk with. So in a way, it's a counterintuitive thing, but it feels like quality adjusted information flow we're working with has gotten better.
Is that because you have to be more focused because you haven't got the resources? Do you feel that because I guess with a bigger firm, you almost have to do certain things, don't you? Whereas here you can just say, right, okay, I can't see the whole market, but what I can do is focus on this particular area.
There's a bit of that, but there's also, you no longer need to attend, X daily meetings of other teams and a weekly macro catch up or multi-asset confab or whatever it might be. And, some of those things, you just sort of spend an hour listening to other people talk about stuff that is really interesting, maybe intellectually, but has no investment relevance to the process that you're running. And that's no longer the case.
I guess another area that people might say is, and I think this is less so with this, but I guess it is worth asking, is that people get worried with something like Woodford, who goes off, sets up his own business and says, oh, I have this greater freedom, I can do this, I can do that. And to some extent, I think that that's unfair for a lot of people. But that is a question that I would put to you, is that obviously within a bigger organization, you've got all those kind of guardrails, protection. And I suspect that within Amati, you've got exactly the same, but it's just slightly different. So how do you respond to something like that?
Yeah, I think a couple of things, really. One, we're very aware of that issue and the issues associated with organizations that go too far out on the risk curve. Our whole approach is to find companies which are high quality businesses that will do well pretty consistently over the long run. So in other words, where we see technologically inevitable changes that are benefiting that business. And we'll talk a bit more about the type of investments we focus on. But within that kind of approach, we've also taken the view that we want these companies to be very liquid. So we limit the size of the business. Typically, we don't buy anything that has a market cap of below about $1 billion. So you're buying very liquid companies to avoid those kind of issues that Woodford and others have had. And likewise, we don't buy unlisted companies. So everything we buy trades daily and with high volumes. So we're very aware of those kind of edge risks, if you like, about going too far out on the risk spectrum. And equally within Amati, although it's a small business, we have a very clear risk approach, rules that we follow as an organization. And we have a risk committee that we sit with every month to review the portfolio holdings and what we're doing in the strategy of the fund. So we do have a lot of other external oversight on top of just the team itself.
Yeah, it's definitely not a free-for-all. I mean, Woodford has been a case researched in great detail, and I'm not going to add anything new, but from what I've observed, in the bigger picture sense, that was the case of a manager moving away from what he was known for historically, and yes, taking those extreme liquidity risks. In our case, we concentrated more on what we've done best historically, innovation and technological change in our kind of change-driven approach in the past. So we were completely within our swim lane that worked for us, for our clients really well in the past. And the weighted average market cap of the portfolio is typically in several tens of billions. So, if our clients can liquidate their holding in a second if they wish to.
So kind of thinking about your strategy, which is the Global Innovation Fund, can you provide background to the strategy, explain what makes you different in what I would probably see as quite a highly competitive part of the market? And then how does your approach align with these kind of emerging trends in global innovation? Because I guess for some people, global innovation is technology. And I know that that's not how you kind of see that.
I'll give you headlines of what we're doing, and maybe Graham will be able to give you kind of more specific translation of what then it looks like as a fund. And we can sort of expand on that. I mean, the first thing you need to answer as an investor, as an active stock picker is, you believe the market is inefficient in a particular way. What is that way? What is the inefficiency of the market you're exploiting and for your clients, and why do you think it exists? And for us, this inefficiency, it's a bit of a narrowing down, a focusing on what we've been doing in our prior careers. We believe that innovation and technological change create a lot of value, or have a potential to create a lot of value. But because of the complexity and uncertainty and discontinuity inherent in change, they're often mispriced. Investors like to anchor and extrapolate the past. Technological change and innovation creates inflection points. Investors are sometimes put off by complexity of innovation and the uncertainty of the outcome of innovation. But we think that uncertainty and complexity is resolvable, can be resolved through focused research, and we do that, and that becomes an opportunity rather than a threat. So that is the inefficiency we're exploiting, but we overlay that inefficiency with a very strict discipline on what we sometimes call buying real businesses, not science projects. The danger of investing in innovation is you get carried away by visionary thinkers pursuing magnificent technological problems long before they've translated their work into a sustainable, cash-generative, profitable business models. We don't get carried away like that. We try very hard to instill that discipline. We buy companies that are cash generative, profitable, have strong balance sheets. And the innovation we're pursuing is real. It's not imagining the world in 10 years' time and working backwards. It's seeing what's already making a difference, what's already adopted by the industry, what's already making people money, both clients and vendors of that innovation, and then riding that adoption curve going forward. And so these are the foundational principles of how we invest in innovation. And what comes out of that is a portfolio that is quite different from lots of other portfolios you can think of when you think innovation.
Yeah, as you say, it's definitely not a tech fund. So we can invest wherever the kind of innovation frontier takes us. So we have 5 different sectors at the moment in the fund. We've had 6 in the past. The whole point is to try and identify a change or an innovation area that is, as Mikael said, that's here, that's happening, that's making a difference, but is still really early in its development. So has a 10+ year kind of trajectory ahead of it. And then we look at all the companies that are exposed to that change or that innovation, and we try and find the subgroups that are kind of the best positions. So that either have the least competition or the highest margins, the highest returns on capital, and typically the highest barriers to entry. So these are really solid, high quality companies that are able to take advantage of whatever this technological change is over that kind of long-term horizon. And because you want to invest for long-term, you need to invest in quality companies that have strong balance sheets and produce cash, because these companies are not dependent on the market to keep them alive and to keep them funded through that growth period. They're self-funding and self-sustaining. And that's really important, again, if you are investing for the long run.
Can you kind of just take perhaps one sector, just kind of bring that alive as to kind of an area that you're looking at or thinking about?
Yeah, well, we use this expression innovation frontiers. If you think about how we research, how do we make sense of this vast variety of opportunities we have to tackle? We start with what we describe as innovation frontiers. An area where innovation is happening, is making a difference, is what we call passes our innovation test. There's clear evidence of adoption and traction. It saves money or improves functionality. We can get into the detail on how that test works, but it's a very real, tangible innovation that's working today. And then we map out what we call innovation cluster, companies that participate in that. We call them pioneers, enablers, and adopters, if you like, the inventors of that innovation, the picks and shovels suppliers to that, and the lateral beneficiaries of that. And you could think, and we wouldn't put you off using that word, but it's a bit more nuanced than that. You can think about this as a very granular thematic approach, except our themes are not this big picture, aging population or digitalization. It's very specific things. For example, one of the areas we're really excited about is bioprocessing and biomanufacturing. And that sounds a bit technical, and it is, but it's transformative. And what it is the whole pharmaceuticals industry is transitioning from what used to be called small molecules, basically chemically synthesized drugs, your aspirins, if you like, the classic, still a dominant share of the market today, towards biomanufactured drugs. They are very complex proteins secreted by genetically engineered cells, but increasingly they are genetically engineered cells themselves, so-called cell and gene therapies. And whereas the bulk of historic sales are still made in the old school small molecule drugs, most of the new pipeline drugs in development and to be launched over the next decade plus, but launched today as well, are biologics and cell and gene therapies. And the way you manufacture that, the one way to think about it is a bit like you're moving from building something in petrochemical refinery to brewing something in a beer brewery. You have this bugs that live, cell lines that live in a vat, and they produce this thing. They've been specifically bred to produce this thing that cures a disease or alleviates symptoms. And the ecosystem of manufacturing technology around that, both companies that are contract manufacturers and companies that are ingredient suppliers, reagent suppliers, and the companies that make these brewing machines, if you like, is incredibly complex. You have to keep the cells alive and productive, and you have to filter this very fragile thing with great degree of purity, because you might be injecting that or infusing that into a patient. It tends to be an oligopoly of very profitable, very cash generative businesses with an amazing business model. They often have 70-80% of their revenues in not just recurring revenues, but revenues that are almost contractually linked for decades to a drug they're helping to produce. So that's one example, riding that transition from small molecule biosynthesis to biomanufacturing and pharma, and buying, in most cases in our portfolio, a couple of enablers, picks and shovel suppliers that make this biomanufacturing equipment and reagents is how we look to make money for our clients from that.
I guess some of these are very complicated businesses. How do you, because you can look at some companies and they say, oh, we run a biotech. I know that's not quite, but we run a biotech fund, and we can do that because we're doctor in this and we understand this. How do you look at businesses that potentially are quite complicated and understand them? Because I guess there's a danger, isn't there, that you don't necessarily understand the intricacies of that business.
Yes, there is. And we call this embracing complexities, another discipline we pursue. I'm a semiconductor physicist by training. Graham started his career in aerospace and defense. Gareth, a third member of our team, he happens to be a PhD in biotech. So we have a degree of academic and professional background that helps. We supplement that for a lot of primary research work. We go to industry shows, listen to technical talks, speak to engineers. When I say industry shows, I don't mean investment conferences when companies speak to investors. I mean trade shows where companies speak to their potential customers or to each other. And so you don't need to be as good as the company in understanding the leading edge of a particular area, but you want to be better than the average consensus global investor, if you like, in being able to engage with that. And that much as we benefit from the fact that we have some academic background that helps, it's mostly through focus and making that more purposeful inquiry and digging a bit deeper and going beyond the beaten track, if you like, and researching that gives you that informational advantage.
And often beyond that, it's really, if you think about what we're trying to do is to find key beneficiaries of a given innovation. And sometimes those are not very complex businesses. So for example, if you think about logistics and automation, there's a lot of investment that's going into robotics and different areas of automation in manufacturing and logistics and other areas. And you can get very quickly tied up in a lot of complexity around how that technology is developing, and there are a vast variety of new companies coming to the market that are providing the latest autonomous robot or whatever it is. But when you cut through and look at a space like that, you find that there are a few key companies that are suppliers to many of these new businesses, and that operate in quite tight oligopolies. And so if you think about areas like machine vision is a sector that's really benefiting from a lot of these developments, not just the ones I mentioned, but also drones and self-driving and lots of other areas. Machine vision is increasingly an important aspect, as machines need to be understand what they're trying to sense, what they're trying to find in a bucket if they're on an automation line, or to see what's around them if they're trying to move around a warehouse. And there are a small number of companies that really dominate in the machine vision market. By going to see trade shows and talk to companies that are in these sectors, we can quickly kind of see and isolate which companies are the real beneficiaries here, without having to understand, be a kind of physicist to understand exactly how the 3D sensor in this machine is really working. This company has a dominant position because it has lots of, it has a big customer base and it has a long history of doing what it does. There are only a couple of other competitors. And if you can find those businesses, they're typically characterized by high margins, high returns on invested capital. And so you can identify these trends and these changes, and then invest with relatively low risk in some of these enablers or adopters of the innovation, without having to be, a kind of PhD in physics or whatever to identify them, if you see what I mean.
Yeah. One of the questions I had down here was around about the top 10 and kind of the Magnificent Seven. I believe that you kind of sold out of NVIDIA. So why not have those? Is it not just easier to say, look, these are at the forefront of innovation? Why stand out from the crowd? Because obviously not having them, then you potentially miss out on that growth. So can you kind of share your thoughts around that, and perhaps also talk about NVIDIA as well?
Sure. I mean, just a few words on our process. First, for any stock to get into our portfolio, it has to pass 4 tests. The first test is the innovation test. Is this innovation real, practical, making a difference, happening today? Is it happening, if you like? The second is what we call company test. Is this company building or have built a great business to benefit from that innovation in a material way? The third test is this a sustainable business doing the right thing? We call it ESGH, adding human rights to ESG acronym. And the fourth and crucial is non-consensus test. Do we think something about this? Do we know something about this, which is research-based, evidence-based, that is not already in consensus view? And that means that it's all things being equal, everything's fair game for us. We can go as, the joke we had a couple of years ago that the smallest company we bought for the portfolio was 500 million market cap. And the largest company we bought for our portfolio was 500 billion market cap. That company was NVIDIA, which of course is now much more expensive. So we made a fair bit of money on NVIDIA. But in the beginning of 23, we could argue that, hey, our view that generative AI is a really transformative technology, which with multiple use cases, with a real investment boom coming in GPUs that enable it, and NVIDIA is best positioned to serve that, was a non-consensus view. Now it's on the headline of every analyst note. Every NVIDIA investor you speak with will say this to you. In fact, if anything, at the moment, our case is a little bit more skeptical. We think NVIDIA not as well protected as people think, and we think the boom might have a fair few hiccups, over the next couple of years, to a degree people don't really appreciate. But broader across the Magnificent Seven, crossing that, non-consensus sort of bar, if you like, satisfying that test, involves us evidencing to each other through a research note, which is fairly detailed. Hey, I think this is happening, and the market is pricing that in, and there's a clear delta between what I think, what I found out, and what the market is forecasting. And Magnificent Seven just doesn't, at the moment, doesn't pass that test for us. It may, again, it had done in the past, but that's the thing. And pick Microsoft, which is probably I wouldn't say the safest, but it's kind of universally loved Magnificent Seven stock. It owns corporate IT. It's a nicely growing business. It owns cloud computing as one of the two leading players in that space. It was early investor in OpenAI, so AI magic dust certainly applies to Microsoft as well. At the start of the fund, we owned a company called PTC, which we still do. We bought it at 20 times earnings, just over 20 times earnings, at 4% and a bit free cash flow yield. PTC makes specialist industrial software for design and management of industrial products. That stock has done as well as Microsoft between the launch of the fund and today. And so we can turn to our investors and say, look, everybody and their dog own a Microsoft for you in size. If you buy an index tracker, you'll have a very large position in Microsoft in that. Not many people owned PTC. So not only we bought you something that you couldn't get elsewhere, we also made you money on something you didn't make money on elsewhere. So we're a complement to what you already have. And that's, as a fund that wants to add something to the landscape rather than become a Me Too product, we wanted to do that.
In terms of NVIDIA, I think I'm right in saying that you've sold out of that. Is there a danger that you sell out too early? Or do you stick to a kind of that discipline that you talk about?
Well, yes and yes. If you stick to a discipline that we talked about, you might end up selling too early. If you're deeper down the rabbit hole on a particular subject and you discovered something before the rest of the market fully appreciates that, there's a chance that you knew something for a while and the market is just getting excited about it. So the tricky bit, Graham, we discussed this a lot, aren't we? Running with the bulls. Are we comfortable trying to be a bigger cheerleader for a stock than an average investor when it's already discovered and widely loved? It's harder. It can be done. Sometimes we have a good reason to do that, but not in NVIDIA's case. Is that fair?
Yeah, I think that's exactly right. So valuation is very important in our process. And when we buy into a stock, we take a view about what the intrinsic value of the company is. And obviously, we're looking to invest in companies where the intrinsic value is significantly above where the stock is currently trading. And that this gets back to that, having something that's non-consensus about our idea that other people, the market in general hasn't yet picked up on to the extent that it's priced into the stock. And so when that is priced into the stock, then there's no reason for us to keep holding the company. And typically speaking, we'll be looking to reinvest that capital anyway into something where we see more upside or a better risk reward. Again, going back to the kind of the core process, the focus is on finding those companies in an innovation frontier where you get the best balance of risk and reward. So we can see the long-term growth, but we're not overpaying for it. And we're buying it in a company that has the right quality dynamics. So, again, cash flow, strong balance sheet. Once the company has fulfilled its destiny as far as the value is concerned, you're not doing yourself or your co-investors any favors by holding it and running with it because of momentum. Because ultimately, if the thing then rebalances back down to what you thought or knew was the intrinsic value, you've only got yourself to blame. And ultimately, we have typically a bench of other ideas that have more upside that we can shift that capital into.
I guess one of the things is that if NVIDIA has gone up, whatever it is, 2,000% in 5 years, the question to ask is, can it go up 2,000% in the next 5 years? And I guess what some investors will see is they'll see that 2,000% and they'll go, I'm going to have that. And then they get disappointed. I guess that's where you're coming from, is that?
Yeah, that's true. And actually, that's an important point as well, in the sense that a lot of investors will feel the pressure because that company is a big part of the benchmark. And so they feel the pressure to invest. And that's the wrong reason to invest, because everyone else is doing it, or you're under pressure from your risk committee to have sort of risk against the benchmark, if you like. Whereas we are totally benchmark agnostic. We look at every company on its merits and on the upside potential that we see from the investment. And we're not under pressure to invest in something because it's a big part of the benchmark, or there may be a sort of one in 30 scenario where this thing really does incredibly well. We'd rather bet where we have very high conviction and there is a very high probability that something can compound 15, 20% a year on the back of an identifiable innovation change. That means we're not really taking a lot of risk. Over the long run, we're avoiding that kind of potential for permanent loss of capital. That's the design of the product.
I mean, I don't make it a secret that I've always been somebody who likes active as a style, but I also understand where passive or index comes into it. And certainly what I've seen over the last 12 months is a real push, with people sharing about academic research that active management doesn't consistently add value. Studies suggest 80% of active fund managers will underperform their benchmarks. How, as an active manager, do you view this, and how would you respond? And I think to some extent, in some of the conversations we've had, I feel that there's an element of de-risking in what you're doing, but maybe I'm looking at it the wrong way. So it'd be really interesting to get your kind of take on that.
We're all a product of our life experiences. Both Graham and I had strong multi-year periods of outperformance, prior firms and our prior strategies, which we're happy to share with investors that we meet. So we definitely see it's possible to outperform, and we can obviously trace that outperformance over, in our cases, 5+, 8 years, that sort of periods, to very specific bottom-up stock picking investment decisions backed by kind of hard yards of primary research that we continue to do. So that's point one. We strongly believe, from our experience, active management can outperform, and we had. But there are certain things that are just beyond debate, academically or otherwise. The reason why passive works is because it's free rise and active price discovery. So there has to be a proportion of the market that actively price discovers for passive to work. The question is the ratio. Is it how many drivers versus how many passengers? The second thing, which again is beyond debate in academia or just in common sense, is the more passivized market becomes, the more uninformed is your counterparty. The person you buy the stock from or sell the stock to in the market increasingly doesn't know what this company do or even how to spell its name. They just bought a bucket of something and shoveled money into it, which means that if you have a research-based informational advantage, it's more valuable in the long run. And that didn't work on average for global investors for the last couple of years, but nonetheless. So if you look at the leading edge of academic research, they talk about this equilibrium inefficiency, that there has to be a certain proportion of active and a certain proportion of passive. They don't exactly know what that number is. They can't resolve it, but there has to be an equilibrium inefficiency, and the market will oscillate around that. Too much passive, active make too much money. Over time, it'll correct. What we see, and I'm sure you've seen that over the years, the most sophisticated investors are doing is they take advantage of the opportunity to free ride. So they have a chunk of their portfolio allocation to passive, as they should. And then for the active, if you like, budget, the risk budget and the fee budget, they want really high active share, really differentiated, really specialist strategies that focus on a very distinct inefficiency. And that's exactly what we aim to be here and what we have done in our prior careers, which is why our active share for this fund ranged between 97 to 99%. So, put bluntly, you cannot get what we own in a benchmark index fund.
Yeah, I think also that it's worth pointing out that a lot of the work that's been done on active versus passive in the past looks at active funds that are closet trackers anyway, in many cases. So taking very small risk positions against the benchmark. And so, historically, investors in funds have been maybe paying for active management, but receiving ultimately is quite small kind of risk benefit to that investment. And that's, again, as Mikhail said, the reason we approach this as a very active manager is to get away from that. to really identify those cases where we see very strong upside that's really undervalued by the market. And if you can hold those companies through the fruition of that development, you will get rewarded, all else equal. And that's if you do that in a concentrated number of names, you can do really well. And that's why we have all of our own money in this approach, because we really believe in it.
I guess one area that slightly worries me, and I don't know the answer, I don't know if you know the answer, is that as passive becomes more popular or appears to become more popular, more money comes into it and it drives up, almost artificially seems to drive up the market, because naturally it buys the market. So more people buy, market goes up. My worry is that at some point that breaks. And when that breaks, what happens? Is it something that could just go on forever? It's almost like a Ponzi scheme, isn't it?
Well, I mean, I don't know if you've read, it's a global macro book by George Soros, The Alchemy of Finance. This goes back to, I want to say mid-90s. I don't remember when he wrote it, but he has this theory of reflexivity, where it's tempting to think about market as an equilibrium system, where if the pendulum swings too far out or somewhat out, it's sort of the force is pushing it back. And his argument that the stock market is a reflexive system, where when things get out of whack, it's probably for some reason, and the other momentum factors, using my words, not the authors, which might push it even further out of whack until it corrects ferociously. And so, you still oscillate around some kind of long-term equilibrium, but your oscillations are initially self-amplifying and then correcting with a vengeance. And I think there's, what you're describing is a degree of that. There's a combination of everything from, if you buy an S&P 500 tracker today, 7% of your incremental dollar goes into NVIDIA. There are not that many active funds that have 7% of the fund in NVIDIA, plenty, but not everybody. And some will be reluctant to own anything more than 5. And then there are other cases that Graham alluded to, where your risk manager says, hey, you're underweight NVIDIA, that's costing you a lot in your tracking error, buy it, because it's a bigger part of the benchmark than it was last year. And so it creates this artificial demand that will eventually correct. And it's interesting, we were discussing it just this morning. We're already seeing a degree of that, because we've seen one of the best-selling index products, not to, just to even within the passive world, one of the best-selling index products has been S&P equal weighted. So that's correcting for that sort of. So maybe as more of that happens, nothing like the profit motive to get the world back into some kind of semblance of rationality. If you see people making money on the other side of that trade, suddenly the whole thing flips. We're not going to call the time on that. We're not going to be trying to time the market, because in our opinion it's impossible. But what it means is we are completely benchmark agnostic in how we think, and we say, okay, this company, will we make our investors meaningful amount of money on that over the period of next 3 to 5 years based on what we know? And if something becomes really popular, it tends to also become really well discovered, really well researched, and really expensive. And that bottom up becomes a guardrail around us participating in that risk.
And kind of touching on that kind of the dominance of the US, quite a large proportion of your holdings derive their returns from the US. If there is a pullback in US markets, because obviously at the moment, very popular, it's been the place to be for 15 years. But if there is a pullback, how do you think that will affect? Do you worry about geographical risk? How do you kind of balance that exposure? Because obviously you're talking about that kind of active share class, about how you're different from the benchmark, or, you're benchmark agnostic. But do you think about the geographical side, or do you just think actually that it's about the company?
Yeah, we definitely do think about the elements of the investment case that are reliant on that geography, if you like. Just a couple of things I'd say. I mean, just leading on from the last conversation about the structure of the kind of active versus passive argument. If you think about, if money were to flow out of the US, out of passive, when the market is so focused and concentrated at the very top end of the market, the Magnificent Seven and kind of the top 10 holdings really in the benchmark, those are the companies that have been really benefiting from those passive flows, and likewise will be likely the biggest losers if that flow reverses. And where we tend to invest is more in the sort of US mid-cap size, if you like. Our average market cap is sort of around $50 billion. So we're buying very liquid companies, but they're nowhere near the very large, $1 trillion businesses that are at the top end of the benchmark. And so the companies we're investing in haven't particularly benefited from the flow dynamics you're talking about, because they're very low down in the sort of pecking order, if you like, of where money goes to. So firstly, we're not concerned really about that flow back. And we can see that in the fact that the valuations of the companies we're buying are still very attractive. We're talking about companies that are, often 4, 5, sometimes 6% free cash flow yields for businesses that have a decade of growth ahead of them potentially, and often mid-teens plus earnings growth per annum. So, these are really attractively valued companies that, even if we do see a sort of reflexive swing back in investment into benchmarks, won't be impacted particularly by that, but do have this sort of long runway of growth ahead of them. And just, if you think about the US, why do people focus on the US market? Well, the US just as a domestic market is just so incredibly large. If you compare it to companies that are operating in Europe, if you're a German industrial company that wants to sell it into the rest of its kind of nearby neighbor market, it has to deal with different languages, often different regulations, different approaches to sales, maybe different market conditions. If you're a US company operating in, pick a state, and you want to start selling into the states around you, which are the size of European countries, you're talking the same language. Typically, the regulations are very similar. There are very few kind of barriers to expanding across that domestic market. So US companies have a home advantage that you just don't get from European companies. And not only that, there are kind of positive dynamics, virtuous cycle dynamics to this. There's more investment in early stage companies because they're just deeper and wider markets. So companies can grow quicker, and then they can expand into a larger domestic market before they have to go overseas. So it makes the US a very attractive and very deep market as far as we're concerned when we're looking for these kind of specific beneficiaries of innovation in the mid-caps.
I think that's really interesting, because I guess it's something that a lot of us don't think about, is that the US does have that unique position, doesn't it? Because, as you say, with Europe, we sort of see Europe as a similar sort of structure as the US, but ultimately how France responds to Germany is going to be different to Italy. And so, as you say, it's more complicated, isn't it? So kind of moving away from passive and how that's dominating the market. But what are your challenges? I mean, obviously you've come from running a lot of money, big strategies, to setting up this fund. What do you see as some of the biggest challenges in growing the fund, and how do you overcome that? Is it just getting that message out there? Is it knocking on doors, or how do you do that?
Yeah, exactly that. I mean, we have this much described chicken and egg situation. If you're a small fund, few people can buy you because of this sort of 10% limit that a lot of investors have, which is a bit, dare I say, ridiculous applied to the liquidity of our portfolio. 50 billion average market cap. The reason that 10% limit exists, investors not wanting to be more than 10% of a particular fund, is linked with liquidity and the impact you will have on the fund if you sell in one go, or your ability to. I guess post-Woodford has become more of a sensitive point, but it doesn't really make sense, in our case, because of the liquidity of the underlying holdings. It is what it is, and we're working with that. So it just, we're just climbing up that hockey stick. We started with 2.5 million. We're now almost 18. So we're approaching 20, where a lot more doors are opening. We find that, if you think having heard what we are, you can deduct what we're not. When we see investors, they quickly realize we're not going to be an innovation fund that dreams very big dreams 10 years out, but doesn't care about the valuation price they pay for the stock or profitability of companies. And that's a very different risk profile, in some ways more prosaic, in some ways a lot more pragmatic, and in our case, a lot lower risk. So that appeals to a lot of people, especially after the experience in this kind of low profit, no profit stocks during the kind of the recent several years of volatility. The second thing we're not a Magnificent Seven in different order. So a lot of our clients believe in innovation and its ability to create value and be mispriced, but they don't like the fact that innovation funds they may look at, or funds talking about innovation, end up with the same names that everybody else has. And we're very, very different. Our overlap with either of those camps is pretty much zero. And of course, we add something that the general purpose investment funds don't have. If you think about the leading, Fundsmith, Linsell Train, you name it, we dig a lot deeper. We go into much more exotic industries where a lot of interesting stuff is happening. Great businesses are born and are thriving. Like you said, they're complex enough for generalist investors not to bother until they become widely known. And that's a real complementary position we're in. We just need to take our time to see more investors and explain that we add something to that portfolio over and above what they already have with very little overlap, and we will make money for them in stocks other people may not know about. And that's been working. So we just sort of plugging away.
What kind of key insight or takeaway would you want someone to leave this podcast with?
Yeah, well, I mean, my big slogans, I guess, repeating how we started: innovation creates a lot of value, it's worth pursuing, but it's best pursued in combination with a discipline of looking for undiscovered names beyond the obvious Magnificent Seven top the benchmark spots, and is best pursued with a prism of real businesses, not science projects, profitability, cash generation, strong balance sheets that mean that you will stand to benefit from that innovation through the cycle, whatever happens to interest rates and in a variety of macroeconomic scenarios.
Yeah, and I'd say it's really about, think about where the world is going and think about the kind of headline beneficiaries of that everyone knows about, but then take the next step and look beyond that to which companies that support those businesses are really benefiting. And often they're the ones that are below the headlines but have great long-term growth potential at much lower risk and much lower valuations. And that's really what we're trying to do. We're trying to identify those businesses that are overlooked by the kind of main investment community, but have great businesses and will do very well.
Thank you both today. I mean, absolutely fascinating. With all of these, I kind of write little notes and I look at things, and it makes me think when you talk about if you have a global index fund, having something that is different next to it is really important, and kind of sticking to your lane as well. When we talked about Woodford and keeping to what and not necessarily being, understanding your kind of, I guess, your limitations, but also having that knowledge and working well. So all of that is just really, really interesting. And thank you. It's been really fascinating. For anyone listening today, if you want more information about Amati and the funds, then their website is amatiglobal.com. And obviously you can go to my website, MoneyWise UK, for more information as well. So thank you very much. Thank you.
Thanks for having us.
George. Thank you.